In this video, I'm going to share with you the boom and crash strategy to grow $20 and $100 accounts. And with this strategy, it requires quick fingers. So what do I mean by quick fingers? This means that you need to be fast in your entry and exit techniques. All right. And we're going to be doing this on the boom 1000 and crash 1000 only, because these two indices are the most indices that is much easier to trade other than the boom 500 and crash 500 index, because on the boom 500 the market drops quickly and the crash 500 the market drops quickly, right? So we're going to be doing this on the boom 1000 and the crash 1000 market. So first of all, we're going to start on the boom 1000 index market, right? Remember, both markets are highly volatile, right? So what we're going to do right here is to start with this market. If I zoom out right here, you can see that before the spike came through on this market, you saw that the market bought up to about 7 candlesticks at this point. Right here, the market bought before there was a spike. So you can see that there's a space in the market after each spike. All right, you can see that there's a space in the market after each spikes, unlike the boom 500 index, right? You can see that there's a space. Now, if I zoom in right now, you can see how the market has sold right here. It sold for a long period of time without any spike on the market. All right, now this is how we're going to do this strategy. We're going to be using few indicators for this strategy because it's a scalping strategy as well. All right, it's a scalping strategy. So we're going to choose on the RSI. I'm going to show you these are the two best simple indicators for you to grow this type of account. We're going to choose on the relative strength index first. The relative strength index, we're going to put it on period 12 while we apply it to closed. Then you put on the levels, you put on 90 and you put 10 right here. Then the style, you put on 3 pixel with this middle line, right? Then for the style right here, you put it on 3 pixels with this straight line here, this first straight line at that point. Then you click on done right here, just as you can see. Then for the second indicator, we're going to be using the MACD indicator. You put on the MACD on the fast EMA 13, slow EMA 25, MACD SMA 10. Then you apply to close. On the main, you put on 3 pixels. You need to draw this one to this point, this third one here. The signal the same, the third one here. You draw it from the start, you put it on this third one. Then you use this straight line pattern. Then you click on done. All right, we're using the second zoom level. All right, so this is the, you zoom out, then you count 1, 2. All right, this is the second zoom level for this strategy. So remember, our aim here is to grow our small account, right? So we're going to be using, for $20 account, you use a lot size of 0.2. that should be the minimum lot size for $20 account, right? You use a lot size of 0.2. so what we're risking here is about 10 to 5% of our account, right? So we're using small lot size as possible. So we're scalping this market. Right now, this is the boom 1000 index market. Now remember, you need to be fast with this type of strategy. So you're going to be exiting the market after each candle ticks. So when the candle tick has been fully created, which is after one candle tick, you exit the market after the first candle tick. Then you place another opportunity for a sell, right? You place another opportunity. Now you take the market right here. You see at the upwards of the MACD on the boom market, there's a lot of spikes on the market. All right, there's a lot of spike on the market. So you enter into the market after the MACD has crossed this line, which is this level of 90. You place a sell. All right, we are taking 5 candle ticks from this market, but we are closing the market after each candle tick. So after one candle tick have been created, all right, let me zoom into the market so you can see clearly. When you can see here, after this candle has been created, you close the trade and you take that profit. All right, then you place another sell opportunity. Right after that candle, you close that profit. Now I'm showing you the best way to manage the risk on the market. All right, this is the best way to scalp the market, the best way to manage your risk as well. All right, now you might have seen a situation on the boom and crash market whereby the market on crash has been what, buying. You see the candlesticks growing for a buy, then immediately the market sells, right? You see the market buying on crash, right, on the crash market, then immediately the market condition changes and the market crash. All right, now this strategy that I'm sharing with you will help you avoid that type of market condition, right? This strategy will help you avoid that type of market condition, because after this candle tick have been created, you exit, then you place another opportunity for a sell, you place another sell. At that point, you're taking 5, but you're closing every candle ticks that have been created. You're closing and taking that profit each, all right, to minimize the risk on the market, right? So after this candle tick have been created for a sell, you close this trade, all right, then you place another sell entry, right? You place on that trade sell entry, then after that candle have been created, then you exit again, then you place another sell entry to secure your profit on the market, so that before you place another sell and a spike entered into the market. Now there might be a situation whereby you place a sell and you are waiting for the full candle tick. Let's say you want to take 5 candle ticks on this market, and you place a sell at this point right here, and the market grow, and you say that, okay, I'm going to exit the market at this point. But as the market continue to sell, and at the 4th candle tick, before you could close the entries of the market, you'll see that the market has bought immediately, right, before you close the entry, and that will end up taking away all the profit you have made from that trade. So with this type of strategy, you can manage your risk. With this type of strategy, you can grow your small account as well, right? So you take your candlesticks each. After this one candlestick have been created, then you exit the market, you place another entry immediately, right? You place another entry, and as you can see right here, like I said, you need to enter into the market only when this right here, when this MACD, this is this line, only when this trend line have crossed above this level of 90, you place a sell on boom. All right, you place a sell on boom 1000. Remember, we're talking about boom 1000 and crash 1000 alone. We're not talking about boom 500, right? So you place a sell on boom 1000, then you exit after that candle have been created. Then if you want to catch a perfect spike on the market, what you need to do is, when this trend line right here have crossed the level of 10, you see this trend line, which is this black line here, the trend line of the MACD. When it crosses below this level of 10, the spike is going to come through. Take a look at this point. When it crossed above, it took just 2 candle ticks before there was a spike, all right, just as you can see. So you can also wait for this perfect opportunity after the crossing, or you see here, after the thing has touched, you saw that there was a spike. Take a look at it, the spike at this point, trace it down to this point, you see there's a big spike on the market. All right, now remember what I said, guys, on boom 1000 index, because the market takes a little bit of time before the spike comes into the market. So what we're going to do is taking 5 candle ticks at the top, right at the overbought zone on the boom 1000 index of the MACD. So the MACD need to touch that level of 90 be after the spike, because the spike will come before the MACD will touch that level. Let me show you guys. The spike will come through after the spike. Take a look at it. This is the spike. So a spike will come through before it touches above this point here. The spike will come through before it touches. So after the spike, you need to see a spike before you place a sell. Then you take 5 candle ticks, then you exit. After one has been created, you exit, you place a sell immediately again, then you exit, taking it like that, so that you can preserve, so that you can minimize the risk on the market, right, to prevent the market from spiking and cutting away your profit. All right, I just explained to you the reason why we're taking just 1 candle tick, then exiting from the market, just to minimize the risk on the market from the spike. All right, then I'm going to share with you how you can trade these on crash 1000 index as well, using the same parameters, and set up the RSI and the MACD. So we'll go to the boom 1000 index right here. On the boom 1000 index, mainly when the spike comes through into the market, is always at the down, all right, always at the downtrend of the MACD. That's when the spike comes through into the market, right? Always the downtrend of the MACD, there's a lot of spike. So what we're going to do is to enter into the market at this point here. When it starts creating an uptrend, that's when you place a trade for a buy. All right, that's when you place a trade for a buy, and you take just 5 candle ticks, exiting after one have been created. After 1 candle ticks have been created, you exit, then you place another buy opportunity, then you exit again, just like that, until the 5 candle ticks have been created. All right, I hope you understand what I'm sharing to you guys. Now you see that at this point here, when the MACD is creating a downtrend, it starts creating a downtrend from this point right here. It starts breaking, going downwards. Then you saw there's a lot of spikes on the market. All right, now for you to catch the spikes, you need to wait until price has gotten to the level of 90. Then you place a sell. That's when the spike is going to come through on the market. Then you can still take a buy when price has gotten to this level of 10 on the MACD. At this point, you're taking just 3 candlesticks from this market because it's the downtrend of the MACD, and when the downtrend of the MACD, there's a lot of spikes on the market. Just as you're seeing here, this is the downtrend. Here, the downtrend, there's a spike. Here again, there was a spike. So when price gets to the level of 10, you place a buy for 3 candlesticks and you exit. After one has been created, then you exit again. After the second one, remember, after one has been created, you exit, you take that profit. Mean that you close all your entries. You can decide to take 4 or 5 entries for 1 candlesticks. All right, you can decide to take 10 or 4 candlesticks for 1 entries. Remember, you're scalping this market, taking opportunities from price movement. So remember that if you use 0.2 lots, the profit will be 10 cents on the market. All right, and if you enter into 4 entries for a buy, that should be about 40 cents as profit from this market. All right, you are taking opportunities of price movement from this market. All right, so I believe you understand what I've just shared to you guys. So if you found value in this video and you really enjoyed watching this video, do well to like and subscribe to the channel, The Daily Forex, for more awesome trading tips and strategies. I will see you guys on the next video.